We're here, of course, at the Exchange ETF Conference. Jeff Gundlach, CEO of DoubleLine, just gave the keynote address, sitting down with us exclusively on CNBC. Jeff, thanks for talking to us. There's 2,100 investment advisors here. They're terrified of the fact that they have 60-40 stock bond ratios in their portfolios, and they're both underwater this year. Particularly, you addressed the situation with the bond market. What are you telling them about that 60-40 portfolio?
I've been advising against 60-40 portfolios pretty consistently for the past 2 years. Basically, I think we're in a world where the risks of inflation and deflation are both real. Right now, we're experiencing the inflationary side, obviously. And so what's happening is the Fed is behind the curve, and the bond market was grossly mispriced thanks to the government's manipulation. And so everything's being repriced. Now, what I've been advising over the past 2 years, instead of 60-40, is actually something more radical, which is a very broadly diversified portfolio. I've been advising 25% commodities, 25% cash, 25% stocks, and 25% long-term treasury bonds, believe it or not, because they're so ridiculously valued, but that's your deflation hedge. And so if you actually have a 60-40 portfolio, 2022 is your worst year to date ever for 60-40. But if you had the 25-25-25, you'd be far better off, because commodities are actually up about 25% year to date. So that will more than compensate for your stock losses and your bond losses. And of course, cash is just dry powder. And so that's what I think people should do. In bonds, you actually should have some long-term treasury bonds for a deflationary hedge. Other than that, you should be barbell. 2-year treasuries, other securities in the credit market that are around that same short average life. Because after all, with this 8.5% inflation rate and a 2.5% 2-year treasury rate, and a 2.8% long bond, yeah. I mean, there's not a great reason to own other than the deflation hedge, the belly of the curve, as we call it. So you should stay in the shorter maturities. You
showed some of the famous Jeff Gundlach charts this morning, and clearly showing commodities are in a super cycle right now. And yet we saw the inflation report out this morning, as you noted. It was light to inline, but that was good enough for the market. It rallied. Where are we? There are some bulls who are trying to argue we are nearing peak inflation right now. Where are we in this inflation cycle?
I think we are near peak inflation, unless you have another surge in price of energy, I think. Inflation is peaking because the base effects are going to be somewhat favorable. We had some pretty big month-over-month prints in the middle of 2021. That I don't think is likely to recur. So we probably are at peak, but it's going to be sticky. It's going to be frustratingly elevated versus, I mean, it's almost laughable if the Fed still talks about 2%. And then people talk about how some magic wand is going to come out and get the inflation rate down to 2%. Because the wage inflation is real, everybody knows it, and the rent component of the CPI, which is a third, is grossly understated and moves up with a lag, so it's going to be frustrating.
You made several jokes about the Fed, which got a lot of laughs here. You said, let's just replace the Fed funds rate and the Fed with the 2-year. Yes. That would be a more accurate way. What do you mean by that?
I'm not joking. I mean it for sure. The 2-year Treasury is what guides the Fed's rhetoric. I mean, the 2-year Treasury was completely subdued in the first 9 months of 2021. It just sat there. I mean, it was gently rising, but it was down below 0.5%. Then all of a sudden, it started to get gear on the upside. And in September, it really kind of broke out. And that's when Jay Powell started to talk a little bit less dovishly. And then in December, by then, the 2-year Treasury was above 1%. And all of a sudden, it was guns blazing. The Fed's like, tools, tools, tools. We're going to use it. We're serious. We're going to fight inflation. And that's what sent the bond market on fire. But it's only because the 2-year went up. Well, the 2-year Treasury is at 2.5% now. So the bond market is predicting that the Fed will raise interest rates 50 basis points in May, probably 50 basis points the next meeting, and then a whole bunch of 25s to get us to about 200 basis points of interest rate increases this year. So up to 2.25%. The Fed, I can show charts all day long that show that the Fed is not a leader. The Fed is a follower. So why not just admit it? why don't I just admit that we're just following wage growth, we're following the 2-year, and just go with it? Because they do it begrudgingly. I mean, Jay Powell came out in the most recent press conference. I don't know how many times he said, we're going to fight inflation. It was just about the answer to every question was, we're going to fight inflation. So they're going to raise rates, and it's because the 2 years dragging them into it.
Yeah, you made some interesting calls on the stock market. Let me turn to that. You said stocks were wildly overvalued by most metrics.
Yeah.
You said you expect the NASDAQ to underperform the S&P 500.
It already is.
And you expect Europe to outperform. Can you explain what the thinking is?
Well, the NASDAQ is very, very volatile, and it's had the same type of run into, say, September of last year as it had into the latter part of 1999. And it's very, very bad in terms of its internals. As the NASDAQ pushed to new highs, the percentage of companies in the NASDAQ that were above their 200-day moving average fell precipitously. This was the warning sign that the market was running out of steam in the fourth quarter of last year because the breadth was deteriorating.
We're running out of time, but I want to get your call on the dollar. You made a very bold call on the dollar. Your highest conviction call, dollar would be going down. Very briefly, why?
The twin deficits, the budget deficit, which of course has eclipsed all records, and the trade deficit, which has gone up a lot with all of the purchasing of foreign goods from the stimulus. The dollar going down is very consistent with the deficits being out of control. In the short term, the flattening yield curve supports the dollar. I'm actually long the dollar right now. So my highest conviction is short the dollar, but not this week. I'm talking about looking forward over an investment horizon of, say, 4 or 5 years.
Very quick answer. For the next few months, do we keep shorting cyclical stocks like we're in some late stage and own consumer staples, or is that trade played out? It seemed like we're acting like we're in a late stage cycle.
Yes.
Yes, what?
You asked me for a short answer. So
you continue to short cyclicals and stay long defensive names like consumer staple stocks.
Yes.
And you're advising that for the next 3 to 6 months.
I would say for 2022.
For the whole of 2022, right? And the dollar still, when is the dollar going to start going down?
In the next recession, which might not be until 2023.
Okay. Jeff Gundlach, always a pleasure. Thank you for stopping by.